So TD is suffering under the weight of concerns of anti-money laundering risks pertaining to its U.S. commercial bank, the details of which were reported in the Wall Street Journal. In fact, these issues were severe enough that the regulator in the United States would not approve its previously announced acquisition of First Horizon. And in early June, a second instance of U.S. anti-money laundering was reported, having taken place purportedly in Florida. So by the end of May, TD is easily the worst performing Canadian bank stock year to date. It's underperformed by about 12%, which is a very large amount. In fact, TD is now the cheapest Canadian bank stock measured by PE multiple, the first time in about 20 years. Specifically, it trades at about a 1.2 times discount after having traded at a premium to its peers for many years. Suffice to say, TD Bank shares are pricing in an awful lot of risk. So let's give some background on TD Bank USA. So between 2005 and 2010, roughly, TD spent about US $17 billion to acquire several US commercial banking platforms, the largest of which was Commerce Bancorp. Unfortunately for TD, Commerce Bancorp closed in early 2008 on the eve of the global financial crisis. And because these acquisitions took place at a time when the US banking sector was much more robust, TD paid a very high valuation to build the platform. On a weighted basis, they paid over 3 times book value. So TD now has a large US commercial banking platform with exposure to several metropolitan areas, namely New York City, Philadelphia, Boston, and Miami. And in fact, this platform is now quite large. It's now 1/3 of the bank, so it's very, very important. So I think it's fair to say that in the last 20 years, TD Bank has transformed itself from a Canadian-focused retail bank anchored by Canada Trust into a North American retail and commercial bank. Bottom line, the current challenges facing this US platform are very important to TD Bank's share price. So moving on to why TD Bank shares are underperforming. In our view, the market is worried about 4 distinct but related issues. The first and the most obvious one is the potential for very large fines from the US Department of Justice and other regulators. It is very likely that these fines are measured in the billions. Now, TD has taken a litigation reserve of US $450 million, but it's highly likely that they'll have to build upon that. The second thing the market is worried about is the unknown impact of restrictions on the bank's operating activities. For example, consent orders, enhanced oversight, an ongoing prohibition of acquisitions in the United States, and any other unknown or unforeseen conditions. The third thing the market is worried about is what's the impact of all of this on the US platform's earnings power? Could it result in higher expenses, for example, in higher staffing, compliance, different processes, technology, things like that? Or does it weigh on the bank's revenue growth because the bank is focused internally instead of externally on growth? And the fourth, but perhaps not as obvious, but maybe more subtle issue weighing on in the background is the unknown impact this could have on any management changes and or normal succession planning. So, given the potential severity of the regulatory response and combine that with the fact this impacts 1/3 of the bank, 1/3 of the bank's earnings, the market is obviously pricing in a very negative outcome. Having said that, until the regulators weigh in, investors just won't know what the impact is going to be. What do we think could happen from here? So first of all, let's talk about what this is not. So over the last 20 plus years, Canadian bank investors have gotten very comfortable with or used to the following scenario. Canadian Bank A records a very large charge, whether it's for litigation, whether it's a fine, whether it's a lawsuit, anything along those lines. The market concludes that the impact on regulatory capital is immaterial, and the stock recovers and as if nothing ever happened. We don't think that is the appropriate analogy for now. In fact, we think this issue could persist for several years. We think probably the best analogy is the consent order imposed upon Wells Fargo, which happened many years ago and contributed for a very long period of underperformance from what was at that time considered to be a very blue chip bank. So what are the possibilities for TD Bank shares going forward? So the first one is the best case scenario, which is that the fines and conditions are, if not minor, are seen to be manageable, and the stock benefits from a pretty powerful rally. The second scenario would be there are severe restrictions, there is a very large fine, call it over $2 billion, but the stock gets a lift just solely off of added clarity. And the third scenario is really the worst case scenario, which is that the restrictions are very severe, the impact on earnings are very negative, the fines are very large and do have a negative impact on capital, and TD Bank shares, continue to languish. So in our view, we think it's very likely that there will be some impairment of earnings from this US subsidiary. We think it's also very likely that just the intense focus on fixing these issues internally does weigh on revenue growth for the platform. And given all of the volatility of the platform and this regulatory overhang, we think it's likely that TD trades at least a modest discount off of some reduced earnings level. Hamilton ETFs is one of Canada's leading providers of Canadian bank and Canadian financials ETFs, with a combined AUM in the category in excess of $2 billion. So what are some of the ways that we offer to gain exposure to the Canadian banking sector? The first is the Hamilton Canadian Bank Mean Reversion Index ETF, which trades under the ticker HCA. This ETF adopts a mean reversion strategy, and it allocates 80% of the fund to those 3 banks that are oversold. It allocates 20% of the fund to those 3 Canadian banks that are overbought. So the idea of the fund is the banks that have lagged will catch up, and then that should, and if so, that will contribute to outperformance. This might be a timely idea for those investors who are interested in TD and Bank of Montreal in particular, because they had very challenging quarters. TD, BMO, and BNS at the moment represent 80% of the ETF's net asset value, while National, Royal, and CIBC represent 20%. The second way that we offer exposure to the Canadian banking sector is the Hamilton Canadian Bank Equal Weight Index ETF, which trades under the ticker HEB. This ETF has assets under management in excess of $600 million. It is an equal weight basket of 6 Canadian banks. And we all know that macro risk and the increasing differentiation and foreign expansion of the Canadian banks is making it increasingly difficult each year to determine or pick the top performing Canadian bank in any given period. So this ETF offers a simple and inexpensive solution to gain exposure to the sector writ large. Its management fee is just 19 basis points. And the third ETF that we offer is the top performing Canadian bank ETF since inception when it was launched, and that is the Hamilton Enhanced Canadian Bank ETF, which trades under the ticker HCAL or HCAL. This ETF invests in an equal weight basket of Canadian banks, of the 6 Canadian banks, but adds a modest 25% leverage. So in our view, this ETF is most appropriate for those investors with a longer term time horizon and for those that believe the Canadian banks will be up over time. So with that said, please go to our website, hamiltonetfs.com, for other commentary, videos, and insights, and please sign up for updates. Thank you.